Hey guys, we are with Markets in Mayhem today. Um, what's the tool name again? So you can explain a little bit about your tool here because it's really cool and I see this all day long on Twitter, on YouTube, and everybody really enjoys using it. And really, like if you're a day trader and you're trading very short-term time frames, you really have to understand the flows and the levels. So can you go over this tool a little bit?
Yeah, absolutely. I'd be glad to. And thanks for having me on. What I have on screen here is Bookmap. And then on the right side of the Bookmap, on that very rightmost column, I've got the SPX options visualizer. And so, what we're seeing on screen is really a heat map of market liquidity. And it's showing us, where people are interested in transacting. We can see that where there's this large resting offer at S&P 5080 on the futures contract. We've got these large resting bids below price. So you can see where there's areas of interest. And what's pretty cool about, Bookmap is it's showing you basically the order book both in the past, where these orders have been, and then where they are at present, as you can see in this vertical line kind of delineating the present from the past. And then what I built into that, because I've recognized through the last 4 years that options have become a more and more important part of price discovery in stocks and ETFs, and of course in the indices. I've added a column in that shows both the flows that are happening in SPX options and then key levels of interest as expressed by gamma positioning. And so, when we zoom out here, we can see how it breaks that all down. We've got a call wall. We've got where there's the largest level of net call interest on the entire options chain. We've got the most active call strike and second most active call strike from yesterday. Those are the hot and warm call respectively, and then the hot and warm put respectively. So yesterday we could see there was more calls than puts by quite a lot, and that hot call at 109,000 was kind of that standout level. And that was a bit of a magnet towards price. Towards the end of the day, price gravitated towards that hot call. And we also saw a lot of open offer interest, resting asks, limit orders sitting at those levels. Similarly, they were sitting at the hot and warm put. So what does this tell us? It tells us that there is convergence in the market, that where there's large areas of interest in options, that typically permeates into what we see in the futures market. And there's a big interconnection there. Like S&P futures trade about $400 billion of size every day in notional value, and SPX options trade about 1.2 trillion in notional value every day. And you have market makers hedging a lot of that options exposure in S&P futures. You also have traders changing some of the dynamics as to how they're trading futures because, with margin costs having risen as much as they have, folks are going to be more inclined to take shorter positions, so they're rolling those things off at the end of the day, or as we've seen more over the last several years, express those views more in options. And so this helps to kind of bring it all together in one screen.
The flows in general, when you're looking at the market, is honestly like in the short term, it's the most important thing. Like I always say there's two different things that are really the big drivers in the market. One, the trend is always the most important thing, but then in the very short term, the most important thing then becomes the flows and the options because you can see gamma walls, and when you can see gamma walls, you can figure out where there's going to be resistance, where there's going to be support. People look at it on a chart and go, okay, this is support and resistance. I think a much better way of looking at it is understanding the actual option flows. It's the same reason why when you're looking at something like, let's say you're looking at something like the S&P 500 and you're looking at the $5,000 level, or sorry, 5,000 level. When everybody's looking at the 5,000 level and everybody's buying options around that level, you'll see that there's a lot of interest in that area and it'll almost be like a magnet, and the market's just
Yes.
pulling to that area over and over again. It's either resistance or it becomes support or whatever it is. So it's really interesting. And kind of the other thing that you'll see too is once the expiration is over, mainly the monthly expirations are very important. So that's the third week of every month, right? Right, Mayhem? I'm right. Third week
Yes,
of every month,
generally third week.
generally third week of every month. And so when you see that come off, then you start to see a move in the market. So most of the time, like March 2020, great example. And I use this stuff all the time for finding reversals. Even the October bottom, that was part of my thesis of in 2022, which is when you get to March 2020, the market's just crashing, crashing, crashing. All of a sudden, the market kind of reverses when you see the huge, that was the triple witching day. So triple witching day comes in mid-March, and boom, the market starts to head the other direction. So most of the time you'll see that kind of change the game. And so this is a tool that you can use to kind of understand it to a huge level, like, because generally, like, you don't get to see that. Like you just don't, it's not something you see over and over again on a chart and it just tells you exactly where it's at. So this is a super cool tool. And I hope some people, especially if you're a short-term trader, like it's a necessity. You kind of need it.
Yeah, and I think it's helpful because, look, I mean, the way I look at it, and I know you have a similar way of looking at things, you know, we concentrate on various time frames, but we also look at multiple data points, right? We look at, you know, what's happening in volume profile, what's happening in price action, what's happening in options, interest, and flows, what's happening in sentiment and positioning. And we take all of that data and we can find these convergences. And so for me, I look at this as one other area to demonstrate where there's interest. Because if we know where participants are showing interest in price, that can help us to make better informed trade decisions. And so, you know, for the longest time before this type of stuff like Bookmap and the options visualizer and others existed, it was about, you know, hey, let's guess with a Fibonacci extension. Maybe
Yeah,
that'll tell us where things are going. And we
I
hope
hate.
that's right. Or maybe we'll take a guess based on previous price levels and hope that they still matter to this market. And sometimes they do, sometimes they don't. But if we qualify this information with more data that we're aggregating based on real views from large participants in the market, where they're positioned and where they're interested in being positioned, that's where I think the rubber hits the road. That's where I feel like we get a little bit more bang for our buck. So, you know, I feel like with everything, don't make it all about one thing, right? So for me, I don't make it all about options. I just find that is one very important area to focus on for multiple time frames of trading. You know, like I was just putting on screen, and I'll put this back on screen. We have a tool that I created for for TraderAid that shows this gamma positioning in the SPX and in some of these other areas. In fact, now I've expanded the tool out so that it works with just about any optionable stock or ETF. And so it's pretty neat because, you know, you're basically able to you know, have something that shows you where there's that interest. And this information is updated, you know, every minute. So on the website, we've got this broken out differently. So even if you're not using Bookmap, you know, you've got these key levels of interest. And you mentioned 5,000. I mean, look at 5,000 on the options chain. That's an absolutely staggeringly large level of put and call interest in SPX options. And that's one of the reasons that I would suspect that'll probably be a pretty important level of support should we test it. But this morning, you know, we're getting closer to 50-50, and we can still see in SPX 50-50, there is a reasonably large area of interest. So that could also be a bit of a magnet. We get kind of pulled towards it, and potentially that area is an area of support. And we can see that in the SPX options visualizer, that comes up as gamma level 1, because when we're doing the delta math between ES and XPX, this is about where that's going to sit.
No, I love the tool because in general, when you like the same thing, could you go back to the chart you just had up
Yeah, absolutely. Give
with
me
the
1
5,000
second
level?
here. Sure. Yep. Let me just pull that up here. And so I factor that based off of full chain, and then I also look at the expiries that are happening that same day. And so we have two different ways of charting that. So this is in the members section of TraderAid. We've got the net gamma positioning on top, and then we've got the gross gamma positioning on bottom.
Yes, so this is really cool because this also illustrates what I was talking about a little bit earlier, which is when you're looking at that 5,000 level and you get a huge expiration, like, you know, March, there's 3 times a year you'll get these huge expirations. March, what's the next one?
June, September,
June,
December.
and September. Yep. So you see these huge expirations. 5,000 will shrink at that point. Like you'll basically see all this interest there, and the amount of interest will kind of disappear. This is why we'll talk about gamma walls and then breaking out over or below the gamma walls. So basically, this disappears. So it's kind of like you have support level. This is what you can't see on a chart. You'll have this support or resistance level, and it's sitting here, and it's really, really strong. And then next thing you know, you'll have this expiration, and it will move out of the way. The market can then break above or below it. So I really like the tool for that reason, especially because it's like you could really do so much as a trader when you understand those simple things. I think in general in trading, we all make it more complicated than it really is. Really finding your style, finding what makes it simple for you, figuring out levels, figuring out support, figuring out trends. Like that's honestly it. Like if you continue, like if you're deciding, hey, I'm a technical trader. I look at the charts, I make all my decisions on the charts, and then I'm going to go to this fundamental thing, and then I'm going to watch the news. And then Jerome Powell said this today, so like your brain's going to go in all these different directions, and then you can't make good decisions. But if you just have a simple strategy and you keep it simple, you'll make money. I think the other thing, and something we could talk about too, is the people have this crazy idea that they have to be right all the time in trading.
Yes.
I was just talking to a guy. We're actually creating a pretty cool product. Like this product's really cool. It's kind of going to take trends and seasonality and kind of boil it into a detrended chart. And it's really cool. It's really awesome. It's kind of next level stuff because seasonality really doesn't tell you enough. You could say like, hey, 90% of the time Bitcoin's up in February, but how big is the move? What's the positive expectancy? Do we have expectancy on it? These things you don't know. So we're creating a product that kind of has all of those things kind of baked in. And so basically it's like, figure out what works for you, figure out your type of strategy, figure out that you don't have to be right all the time, because he is the person I'm working with is talking about how, his idea is to be right every time. And like, he's going to be right every time. He's a mathematician. He's a very smart guy, much smarter than me. And at the same time, when you look at it and you go, okay, well, there's a difference between being right and making money. And this is something you and I have talked about a million times, which is, I've had years where I had 2 insane years in trading as a fund, even 2020, 2021, insanity years. And I've had great returns, but those just blow everything out of the water. And those years I had really low win rates, like really low win rates. And so what does that tell you? It tells you if you hedge your downside and you open up your upside, you can have huge returns without having to be right all the time. Most of the time, a system that's right all the time will blow up at some point. I don't know what point that will happen, but at some point, as you're trading a system that says it's right 90% of the time, you're mainly taking these very small trades to get that type of win rate. So as you're taking these very small trades to get that type of win rate, let's say you're making 1,000 per trade. Let's say you have, a huge account, you're just making 1,000 per trade. You're sitting at home. You feel great about it. And then it goes the other direction. Then you have one loser that loses 10,000. Then you're wiped right back out, so once again, it's not about having a system that wins all the time. It's about being able to hedge your downside so your losses are small and increase your upside. And depending on the type of trader you are, as a day trader, your upside is going to be smaller, so your win rate is going to be probably higher. If you're a swing trader or a position trader, your win rate's probably going to be lower because you're looking at these insane moves and these outlier style trades. So figure out what type of trader you want to be, but also just remember, whatever you're doing, you don't have to be right every single time to make money.
Yeah, I think one of the key facets of trading psychology is removing our ego and our emotion from what ends up being the outcome. Because I see all too often that people go into a trade and it goes against them and they say, oh, it'll come back. I'll lower my stop. Or, a trade that's working for them, they say, oh gosh, it's working. I don't know if it's going to keep working. I'm just going to take my profits now before it really takes off. And that's so self-defeating because you end up, taking these larger losses than you should and not harvesting the level of wins that your research shows that these trades may turn into. And I found for people that I work with when I'm coaching and just having broader group discussions with our members at TraderAid, that it tends to be more about not having a system, or having a system but not being confident in it and then not sticking to it. And so I feel like one of the most important parts, and you're touching on this here, is like understand what kind of trader you are so you can build a system around that. Because if you see folks out there saying, hey, I've got a 100% win rate, I've got, a Lambo, I just bought a house, I'm only 12 years old, like that kind of stuff is nonsense. I mean, I'm just going to be honest with you all. I've been at this game for almost 20 years. I've met all kinds of folks from all different backgrounds and varying levels of success, and no one out there that I've met is loud about their winnings, about their wealth, about any of that. But more than that, all the best traders I know are very humble and very transparent. Like, this is how I trade, this is how I do it. I don't always win. When I lose, this is how I tend to manage my risk. Like, if you're going to survive at this game, you have to admit one big thing to yourself. You're not always going to be right. You might lose half the time. But if you're cutting those losers quickly and you're understanding why they're losing, and then you're focusing on trying to, make sure that you're riding your winners as they continue to work, that can be a game changer. And it sounds very simple. Like, as we're discussing this, it sounds very simple, but it's not. It's not that simple at all. I think that, it is a matter of just sort of reprogramming our own expectations, our own psychology, so that we can do a better job for ourselves, because trading is a business after all.
Yes.
And to be a business, you have to be solvent the next day, which means never taking so much risk that you're not there to open up shop the following day.
No, I love that. And that's honestly everything in trading, which is understanding your risk is number one. People always look at guys like, Paul Tudor Jones. Like, for example, if I told most traders today that Paul Tudor Jones has decided to short the market today, and let's say it was like, on Bloomberg, everybody would try to short the market with Paul Tudor Jones. Like, they would go, okay, he's right. He's always right. He's a genius. Like, let's short the market with Paul Tudor Jones. And they would never listen to what the guy actually said, which is, read Market Wizards 1. Paul Tudor Jones has a great quote in there, one of my favorites of all time, which is he talks about, basically back then, every newspaper would run this stuff with Paul Tudor Jones, and they would go, Paul Tudor Jones shorts the market right at the top perfectly, makes all the money, blah, blah, blah. And Paul Tudor Jones says, yeah, because it doesn't sound as cool to say Paul Tudor Jones on his 5th attempt has shorted the market, because that's the truth is he would talk about these things. And because you're not going to win every trade. You cannot possibly win every single trade. Everybody wants to. And if you can create a system, like I've seen people create systems over the years, big funds, retail, whatever, where they're right every single time. They blow up every single time, because every time you have a system that finds some edge, that edge will disappear at some point. If you have a 100% win rate system, somebody else will find it, somebody else will exploit it, and usually there's a huge risk on the other side. So basically, you say, what was that fund? Long-term capital.
Oh yeah,
long-term capital is a great story. You basically get all the PhDs. I forget his name, Jim. It's not Rogers. It's the other Jim, the guy who writes all the gold books. I can't remember his name, but
Rickards.
Yes, Rickards. There we go. So Rickards was one of the PhDs there. They just had all these PhDs there, and they basically put everybody in a room, and they came up with these 100% win rate trades. And basically, they made a bunch of money for a couple years, and everybody was like, everything's great. And then they found some like 100% trade in the ruble, and they took it on with everything they could possibly have, like full leverage, leverage the whole fund, and they blow up the fund and then some, because they take so much risk on, because they go, well, it can't lose, so like we might as well put everything into it plus some, and boom, something unforeseeable happens, and next thing you know, we're here. So that whole thing blows up. And this happens over and over again. Like, we've talked about the optionsellers.com guy before,
Oh yes.
basically selling calls on oil, or sorry, selling calls on
Natty.
natural gas, because
Oof.
because it's in a huge downtrend for all those years back in 2015 to 2018. 2018 happens and natural gas explodes higher, which wipes out all of his naked calls. And then at the same time, the other part of his strategy was selling naked puts on crude oil. Crude oil then crashes at the same time as natural gas skyrockets, and here we are today. Here we are in this blow up that was of massive proportions. And he makes a video, and it's really sad. Like, honestly, like, I feel bad for the guy, because I don't want to
Oh
see
yeah.
anybody like
It's
lose
terrible.
money for that. But at the same time, it's like, it's a great cautionary tale, because the guy's sitting there and he's talking about, like, his clients. Sorry, I lost your money. Like, he made a full video on it. And it's really, like, it's really sad, but this is what happens. It all happen in trading. So especially when you have these huge moves to these huge degrees, and everybody thinks that they could just be, it's impossible for this to happen. And because I've created a system that always wins, that's when you get into trouble. The new one today is a lot of funds, and we're possibly going to see some major blowups in that area. A lot of funds are using the cash bonds and selling the bond futures.
Yes, the basis
And
trade.
yep, the basis trade, and they're making the middle. And they're just, once again, it's a trade that can't lose. I was told all you have to do is predict recessions and you can make all the money in the world.
Oh,
Um,
well, I'm sure someone's figured out how to do that, right?
of course, it's obvious. So many people, everybody calls for a recession every other day, but one person's probably completely right every single time. But
Absolutely.
once again, it's like, that's another thing that can blow up. So it's actually work for me. And when I hear people say, like, I have a 90% system, I have an 80% system, I always think either fraud, you're lying, or there's a situation where you're going to blow up very soon. So the bigger thing is to figure out is what's expectancy. Expectancy is the outcome of your system. So basically, if you're looking at it and you're making, let's say, $100,000 portfolio, to make it an easy number, let's say you're making $5,000 per trade. You have 5% is kind of your average winner, and your loser is $1,000. So you're only losing 1% of your account per trade. Now, this would be positive expectancy. This system could be wrong a lot, and you would still make money. It could be wrong a ton and you'd still make money. It could be right 20% of the time and you'd be flat. So once again, it's understanding those things will be the thing that makes you a lot more money than trying to be right. And it's a thing that you and I run into a lot with new traders all the time, which is like, they want to be right every time. And it's like, number one, there's a difference between being right as an analyst. Like, let's say today I say by the end of the year the NASDAQ will be up. That sounds really cool, but let's go back to 23. We had a long trade in the NASDAQ. So we have two different accounts that we run. One is an ETF portfolio, long-term, kind of like a retirement style account. And then we have a futures swing trading portfolio. So in 23, you have this massive uptrend. We get our first signals to get long in January 23. We're long the NASDAQ. I could say right there, by the end of the year, the NASDAQ will be up. I was right, but how do you trade it? So there was a huge crash in the NASDAQ in the middle of the summer into fall. So the NASDAQ in September through October came down pretty hard, had a very huge pullback. So once again, it's how did you trade that? In the swing trading portfolio, we had to get out of the position and back into the position. In the long-term portfolio, we could hang on to the position. So there's two different ways of looking at this, which is, getting every single trade right and every single idea is a thing that you can do when you're just calling things out. But when you're actually trading, there's going to be I got into the trade 3 times. I mean, and Coco, perfect example. I should talk about this because I have people coming at my head every single day about this now because everybody wants to know more about cocoa, which I find funny. You and I are probably the few people who actually markets. But so cocoa, if you go through my system, and I've posted this before, I'm completely transparent on these things. I had 15 trades, I think, over the years that were flat, slightly up, or slightly down. Like basically hit my stop, completely flat, or they just were, slight winners. And cocoa was just chop. It was full of chop. So a ton of losing trades over and over and over again. I even talked to a couple of different trend followers who pulled it out of their system because they just couldn't handle it anymore. Because it just
it was such a difficult instrument to trade, and there was so little interest in it that all the ETFs were at close. There were several ETFs for cocoa. I'm sure those issuers are now kicking themselves, wishing, gosh, if I just stayed in a little longer, the kind of fees that I could have harvested on this would have been extraordinary.
And honestly, that's telling in itself, because when you see, like, and we should bring this up because people watching might get something out of it, which is, as you know, when that happens, that's capitulation. Yes. Everybody finally gave up. And I think my strength as a trader, because that's the thing, at the end of the day, you have to figure out your strengths as a trader. My strengths as a trader is always the same thing for me, which is I have an ability to handle loss very well. So, chop over and over again all these years, I have a feeling in my head, and I also have a vision in my head of cocoa could go up a lot. I don't know. Like, look at the commodities for the last, do you think it would have been fun to be a commodities trader for the last 10 years?
No, it's a disaster for a lot of people.
Yeah, it's been rough. And there's a lot of shorts, there's a lot of chop. Hell, there was a time where there was zero going any direction in my system, which is nearly impossible. But there was a time, and that was 2017, where there was so many of them that only a few of them were getting buy signals. I think it was Palladium was one of them. But the rest of them were just chopping around so hard that they were all in neutral territory.
But it's interesting that you mentioned that, because that was around the same time that we saw a lot of major banks closing their commodities desks. Mm-hmm. And that was another form of that capitulation, that larger exit from participating in all manner of different commodities markets. So you had, the delisting of ETFs more recently, but you also had, Goldman and UBS and Deutsche Bank and Citigroup and others either consolidating or just completely exiting the commodities market, over the years that followed really that big downfall, 2014, 2015. The years after that, more and more banks left. And I think that speaks to your point that, that might be something that some folks look at conventionally, thinking about it saying, boy, that seems pretty negative for commodities. But the reality is less participation means it takes less volume to move price more. So it actually becomes, by nature of that lack of participation, that order book thinning out, a more exciting trading instrument over swing timeframes.
Yes. No, perfect. Yes. And, it's understanding that part of the markets, you'll see an ETF go out, where, you'll see ETFs just blow up all the time, or people just get done with them or something. And look at USO, it got restructured right at the bottom of the market. You could see that over and over again in commodities. Commodities are a very interesting area. And I think that's something that should be talked about too, is that some people will hear me talk about commodities and think I'm long commodities all the time. It's no, I'm long and short commodities all the time. There's none of them are always in an uptrend. There's things like corn, there's things like soybeans, there's things like wheat. Those are all in downtrends. They're short in the system right now. Do I have a fundamental thesis that they could move up? Absolutely. But another thing to also think about, and we could talk about this too, which is correlations. So correlation, when you're looking at commodities and people are going, commodities are going nowhere. Commodities look terrible. Commodities this, commodities that. Inflation's never coming back again. When you think about that, you have to also go, well, what commodities are moving up? So if I look at my futures market and I look at, let's say, the performance over the year to date. So cocoa's up 50%, which is crazy. And I'm not saying that's normal. So cotton's up 25%. Lean hogs are up 15%. Feeder cattle's up 14%. Sugar is up 13.5%. Orange juice is up 12.5%. Crude oil is up over 10%. Heating oil up over 10%. Live cattle up over 10%. Gasoline up 9%. So why do I bring that up and talk about correlation? So what I'm bringing up is when you see cattle and hogs leading the way, what exactly feeds those? That's things like corn and soybeans.
Yes.
So corn, soybean, not soybeans exactly, but soybean meal. So soybean meal is near the bottom of the list on performance. It's up it's down 14%. Corn is down 12%. So these things are almost always directly correlated to each other. There's people who run literal funds that are nothing but spread strategies on cattle and corn and soybean meal, because you can basically make a ton of money just understanding that one correlation. So when people say commodities are dead, we're not talking about like they're not understanding the complexity of that market. Also, indexes like the CRB, as you know, they're heavily only invested in things like energy. They're heavily
Yes.
invested in energy.
That's a
And then
really important
things,
point.
yes, and then things like cocoa and cotton are non-existent, because people talk about, well, cocoa's up so much, why aren't the commodities moving? Well, cocoa is non-existent in that index. It has, yes, it probably has a 1% or 2% weighting, but that's not going to drive it up. Cotton is also not very large in there. Cattle, hogs, these things are, and orange juice, these things are non-existent in there. And these have been
You
going
know,
up for years.
it's interesting too to contrast the broader commodity indices with some of the ETFs. And let me preface this by saying I am not a huge fan of commodity ETFs because the tax implications are somewhat problematic, both on, you're subject to the wash sale restriction on the one hand, and you
Mhm.
don't have necessarily as preferential treatment on your gains. But on the other hand, you're probably going to receive K1 schedules for each commodity ETF that you trade. So with that disclaimer out of the way, what's interesting about DBA is it actually has weightings that are really different than the commodity indices. Like there's a lot higher weighting of cocoa and feeder cattle and other winners in that DBA Invesco commodity ETF than you see in the indices, which is one of the reasons that it's making all-time highs, while the broader commodity indices are trading at levels that we haven't seen since 2021 on the low side.
Yes. No, that's a great point. DBA is one that it starts moving, and people go, I don't understand. And really, it's just commodities are complex. And like you said before, like I'm also not a fan of the ETFs. I like the futures. It's a play on the actual product and purely on the product. But when you're trading the ETFs also do create a lot of alpha too, so you can trade them. They're just a little bit tougher to trade. So once again, it's a big, it's a lot of confusion behind all the commodities. Like I think in general, it's the market that most people don't talk about, they don't think about, they don't trade as much as they should. Like honestly, commodities are great trading vehicles. They're not investment vehicles. That's the other thing I was trying to get to that I forgot about. It's early, it's not that early, but it's been a rough week. But basically, when we're looking at something like the commodities, you have to understand all of those things to kind of grasp where and how to invest in them, and the fact that they as a trading vehicle, they do not. It's not something where there's the Ray Dalio method, and he talks about just have a commodity ETF 10% in your portfolio. I totally don't agree with that. I think that's honestly a ridiculous thing to do. I have back tested it. I do not think that's something that's really the outperformer. Yes, there are times where commodities have huge moves, but once again, it's like you want to hold something that could be in a downtrend for 10 straight years. I don't think that makes sense. I think the way to do it, if you are completely passive investing, is commodity wise. If you add something like gold to your portfolio, gold is a little bit different than a normal commodity. It is it has another aspect to it, which is monetary, and so it kind of keeps a bit of a premium because of that. And so something like gold is something you would rather in your portfolio than something like a energy based commodity ETF. Oil's hit its all-time highs years ago. It's who knows the next time it's going to hit its all-time highs. It could this year, it could next year. I'm not saying it can't. I'm just saying that you want to be in things that are continually in major uptrends, not things that are in flat to down periods. However, why I keep saying it's a great trading vehicle is that movement, that explosion higher, that explosion lower. Like, that's where you get your alpha as a trader. You don't get your alpha as a trader because things are moving up slowly and nicely and it looks pretty in your portfolio. You get your alpha because I can short this. It's making a lot of money quickly. I can be long this. Oh my God, Coco's up 200%. Like, you look for those outlier trades.
Yeah, I think that's an interesting observation. I would also add into it that, for folks out there that are longer term in their thinking and want lower maintenance in their portfolios, the other thing I would say is I think we're at an inflection point where it makes sense to consider, do certain resource producers and intermediaries make sense as a greater allocation in one's long-term investing strategy? Because quite frankly, there are a lot of very cheap energy companies, miners, grain, producers and processors and otherwise, that it makes a lot of sense to consider. And again, not investment advice, but just looking at this and, maybe this is the beginning of a broader cycle for some of these commodities. I think it's interesting to take that into consideration. The other thing I would say is with DBA, it's fascinating to think about, cocoa is about 19% of that ETF now. For whatever reason, I don't know exactly how they manage their weightings. I'll have to look at that at some point, but it seems like it's almost momentum proximal, because I've seen this happen with DBA where it kind of reweights things based on performance. And then going back to something that we discussed a little earlier, one of the things that I thought was really interesting is, you had talked about some of these trades that get very crowded, that people think they have like 100% win rate and nothing could go wrong until it does. And, we saw Volmageddon in 2018, right? We've seen situations like that where people get incredibly stretched short vol. We're back there. In fact, some analysts would argue that we're actually the market is more short vol now than it's ever been before. Now, vol is well supplied on the other side, right? There's plenty to short because people are still piling into some of these different hedging instruments, particularly the S&P puts. But at the end of the day, when you've got this much systematic trading that is short vol, long equities, if there was ever any kind of outlier event that shifted that paradigm where vol is aggressively bid and equities are aggressively sold, you could have a pretty broad catalyst to add into that trade. And a lot of those, it could never go wrong, sell puts all day type of trades could actually end up becoming rather deleterious to those same portfolios. So it's interesting because that short vol, long equities, sell puts, long calls type of trade, however it's being taken on, has worked really well over the last year and several months. But there is a growing chorus of folks saying, okay, this is starting to become maybe a little bit more of a problem, if, the caveat being if, of course, we see a big shift higher in vol and lower in equities. And so it'll be interesting to see if that emerges. I think if it does, it's going to be more driven by rates than anything else. It's certainly, not an earnings story. Fundamentally speaking, we're out of the earnings recession. We have been for, at least 2 quarters now. We see that mostly led by mega cap tech, whereas the broader S&P, the rest of those companies are kind of lagging in their growth, but there's still growth. But if we look at rates right now, there are some divergences between what are typically positive correlations in longer duration risk and where we're seeing, say, for example, 10-year note futures or corporate bond futures or high yield pricing going lower as stock pricing is moving higher. That's something to take into consideration, particularly because we're seeing that expressed in a number of different areas. There's greater divergence between inverted vol and equity pricing, whether it's inverted equity vol or inverted vol in fixed income products like the MOVE index. So there's a number of those kinds of things happening underneath the surface. And this is all with the context of a market that is experiencing some of its most deleterious breadth since 2009, if we look at the divergence between equal weight and market cap weight performance. So it doesn't mean there's anything imminent around the corner, but what it does mean is that there's some yellow flags here. There's some reasons to be a bit cautious. Typically, when a market continues to make all-time highs, you want to see a broadening out of upside participation. You want to see more and more stocks making all-time highs, moving above various key moving averages. We're not so much seeing that here. It's really a concentrated rally, and that's a departure from what we've seen from prior bear market lows. If we look at prior bear market lows going back to 1982, it's interesting to take into consideration that every single one was led with outperformance by small caps and equal weight. This is really the only bull market we've seen since then that's been led by a concentrated few with market cap weight outperforming small caps and equal weight handily. So there's just a number of different things sort of building underneath the surface that tell me as a long-term investor, I need to be a little bit more cautious about risk, particularly if I'm taking it in some of the more concentrated areas of the market. And there are some signs as to what that risk off might look like, what those early stages of risk off might look like. To me, it would look like rates really pushing closer to 5% on the 10-year. It would look like the dollar starting to cross 105. It would look like the VIX starting to push above 20, and it would look like the S&P starting to see a bigger drawdown. That would all exacerbate the risk that it kind of feeds on itself and becomes a broader correction in price rather than just time. So those are some of the things I'm kind of looking at. And the reason I'm mentioning this is just as, I manage multiple long-term portfolios for myself. I've got my, trading account. I've got my taxable investment account. I've got multiple retirement accounts. And so I take all this into consideration in my investment decisions. Like, am I going to get more aggressive with my dollar cost averaging in this type of environment? No, quite the opposite. If anything, I'm more likely to lean into trimming some longs, taking some profits, and then reinvesting that in some of the safer areas, like getting some yield off of short-term bills.
No, I love that. That's like there's a lot to unpack there. One thing that you brought up, which I thought was just phenomenal, which is the idea of investing in companies in these commodity-driven areas and countries. To me, that's two things that I think I do well. I think I do well. I don't know. I have good returns, and I think I'm pretty good at picking those. I think it's something that I've always kind of gravitated to, but I think the reason is because that's what I'm concentrated on. I don't concentrate on too much. I think that's a thing that too many traders do. People see me all the time. And they're like, man, you trade so many different things. It's like, no, I don't trade any individual stocks. Because I don't trade any individual stocks, I have the ability to understand the sectors more, understand the countries more. And so once again, you can get a lot from, even my service. What we do is we pick these things, and people ask me, I'm a stock picker, how exactly would I use this? And the thing I always say is, well, if you see that, we're finding a lot of value in something like financials, we're finding a lot of interest in something like industrials, you can dive into those areas and kind of dig through those areas to figure out where you'd like to be. And what you brought up there is great because there's so many of these sectors, like ITB's been one we've been in. Once again, it's a little bit insane right now. I wouldn't suggest people go out and go full into ITB today or XHB or any of the home builders, but that's been a sector that's been moving really nicely, kind of outside of the tech-driven bubble that we're kind of seeing. I'm not saying it's a bubble as in it's going to crash tomorrow. I'm saying it's pretty crazy to see where tech has gone. Yes, we're trend followers, so we're long trends, but at the same time, I can see that this is getting a little long in the tooth at the moment. If we look at something like financials, the banks are also looking like they're starting to hold up. XLE has a ton of value inside of it. Same with XOP. So XOP is the oil and gas explorers. You trade that as too, Mayhem. So I know that you also see that sector too. And so for me, I'm looking at these areas and going, okay, this is an interesting thing you and I can talk about too, which is I'm seeing that we're kind of moving into a zone where investing in those things it has a huge opportunity at the moment. Because we might be running into a reflationary style regime change. So that would mean, so people think of that and they go, okay, well, look at 2021. everybody went, oh, well, tech did well in 2021. Well, it really didn't. If you look at the areas where you could have been in, because you have to stop. People think too much of like, oh, well, I've made money, everything's fine. Really, it's not. That's not it. You have to figure out where's the relative strength, and whether it's downside or upside. Like, let's say you're a fund you have a agreement with your basically your prospectus said you're invested 100% of the time. I wouldn't suggest that, but some people do that. If you do have that type of, think of yourself that way, and you can go, okay, well, if I'm in 2020 and I'm in the middle of a crash, I should be in gold, semiconductors, these things that are showing relative strength. If I'm in 2021 and tech is kind of got long in the tooth after COVID, I could be in things like energy. I could be in financials because that reflationary trade started to take over, and those massively outperformed that year. So once again, now we're moving in today. We're seeing the same situation. We're seeing that tech is a little bit long in the tooth. It's been going up for a long time. Money is starting to flow into these other areas. There's no reason why that couldn't take over, but also what that tells us is that the commodities trade would start to move as well across the board. Right now we're seeing select commodities moving. Then we'd see it across the board. And the other thing to talk about, because I'm looking at the sectors right now, and there's a lot of things that are looking really interesting at the moment. Year to date, you have XLI has done pretty well. It's up 6% year to date. XLV is up 7% year to date. XLF is up 7% year to date, which is financials, healthcare, and industrials. IGV is another one. Software is up for almost 5%. So you're seeing these areas start to move. Even IBB, which is the biotech ETF, that's starting to move too. So as we go back to the global markets, this is where I'm starting to find a lot of interesting stuff that I'm excited about that I think could be the major outperformer. Because people will go, oh, well, the U.S. has been the winner all these years. And it's like, yes and no. Not saying to not invest in the U.S., but there's been other areas that have had major outperformance in the U.S. Yes, if you group every single one of these together and throw them into an ETF or an index, yes, they underperform. But if you look at it this way, then you can go, okay, well, where are the areas that are outperforming? Poland is an outperformer right now. That's something that people don't really, think about much. Poland is an outperformer right now. It's up 10% in a month. If we look at South Korea, it's up 7% in a month. Then we have Egypt up 10% in a month. We have Israel up 8% in a month. So there are these areas that are showing some major outperformance. Vietnam has started to look good. It started to kind of break and start to break out of a head and shoulders band squeeze type pattern. And so that's moved really nicely. India is up 15% year to date. Australia is up 11% year to date. And then there's Saudi Arabia is one of our picks. That's up in the last 3 months. That's up 12%. So there's all these areas that you could be looking into over your time instead of just looking at because I think too many people just go, it's got to be S&P 500 and the stocks inside of it or nothing. And it's like, there's a whole world out there. There are tons of sectors out there. There are tons of things you can invest in. And like you mentioned, taking your portfolio to the next level for me really is understanding those areas, putting money to work in the times that are right in the cycle. So let's say right now we've made a ton of money in tech. That doesn't mean I'm ever going to close those positions until I get a sell signal. I can't understand it because at the beginning of this year, that was something that everybody talked about. It's over. Look, we had 2 down days. I had one person, the guy actually, but I'm not going to say a name. But we had one person say, yes, 1 day doesn't make a trend, but 2 days certainly does. And he was talking about tech being down the first 2 days of the year. Yeah. And that's just funny. But once again, when you're looking at something like that and understanding hey, I can stay in this trend, but also I can understand that these things are starting to move. That's why it's important to not trade too big so you have cash on the sidelines. Then you start to add to these other positions. Now we're looking at, energy is a new one that we're continuing to get into. Then we're looking at things like Vietnam, like we just talked about, which we got into. Saudi Arabia was one that we got into this year as well. So, you can kind of start to position yourself into these areas without having to take away like this upside that you could continue to gain. But once again, it's like if Mayhem is correct, and I think that's a correct assessment, which is we have to see this market broaden out at some point. Any good bull market has rotation. It's the first thing that I ever learned about trading and technicals was that the lifeblood of any bull market is rotation. And so we're not seeing it yet. We haven't seen much of it yet. So I'd like to see some of these other sectors start to take over. Another one that we didn't talk about much because it's is Japan. Japan's also another one that's just been unbelievable. It just continues to break out, and that's usually a good sign for how well the market can do and can continue to do.
Yeah, I think it's interesting to look overseas as well. I've been a big fan of trying to diversify because I feel like there's just a hyper focus on basically 10 or 20 US stocks and maybe two US stock indices as to where most people are putting their funds. And that's fine. It's worked, but at what point does it make sense to start considering diversification? And so, you've mentioned some other areas of opportunity. I agree 100% with Japan. I think last year my best pair trade was long hedged Japan and short China. And so the idea there was, look, I don't want to be long the Nikkei alone, because if I'm long the Nikkei alone, I'm taking a lot of currency risk in the yen. But there's this awesome little ETF called HEWJ, which gives you a hedged exposure to the Nikkei. So you're basically buying the Nikkei, but you're shorting the yen at the same time to net out that currency risk. And that's been an absolutely stellar outperformer. It's outperformed US markets on its own. When you added the China short trade last year to it, it was, broadly outperforming just about everything out there. And this was a trade that was qualified on relative strength and relative weakness. Japan showing relative strength versus global stock indices in the S&P, and China showing the opposite. And, China is starting to show some signs that maybe it's stabilizing as they throw as much money into the cash furnace as they can to stabilize their equity markets, but nothing of a durable nature has happened there. So I'm still not interested in investing there. But when I look at some of the other countries in Asia, it's a bit of a different story. South Korea is starting to turn around with the semiconductor demand we're seeing globally. We're seeing EWI really start to pick up. We're seeing the Philippines, EPHE, also really starting to gain after consolidating for a long period of time. It looks like it's breaking out. Vietnam still in a point of decision, but watching that one with interest. Mexico has been one we've been in since last year at Macrovisor. We've really loved the reshoring, friendshoring theme that has been stimulating their economy, and also the fact that their central bank was one of the few in the world that was really aggressively hiking rates in 2021 when other central banks were calling inflation transitory, and now they have the policy flexibility to begin to lower rates and stimulate their economy. So there's a lot of tailwinds there that have me more interested in that. And we see that kind of, in India as well. That was one of our picks last year. It continues to perform this year. This is a real story of earnings expansion, of economic expansion, of a rise of the middle class. This is now the most populous country on earth. They're not facing the same kind of population decay that China or to a greater extent Japan are. It's quite the opposite. And so there are opportunities outside of US stocks that can not only outperform the US market, but also broaden our horizons and provide some degree of uncorrelated returns. And that's important because if your entire portfolio is just keying off the S&P, and you have a large drawdown in the S&P, then you're not going to be having a good time. But if you broaden your diversification away from just US stocks and you have, a little bit in Japan, a little bit in Mexico, in Philippines, and India, and otherwise, just as examples, you may find your returns are less correlated with US markets, and that can end up being beneficial, particularly during times of greater tumult in equities. And so I feel like, it's not only a conversation of where do we find alpha, it's also a conversation of how do we best preserve capital in a time where, we haven't really seen the health of the US rally improve. So it gets me a little skittish wanting to be, max long US exposure. But at the same time, we do see that improvement in breadth in a lot of these other countries and the rallies they've been experiencing, which has me looking at them with greater interest. And it's the same thing that we talked about with the commodities market. The idea that, look, there are genuinely cheap operators here. There are genuinely cheap companies in a lot of these countries we've talked about that make US stocks look absurdly overpriced. Now, that matters a lot because, for a while, fundamentals haven't really been a key driver of price discovery, but that can and likely will change over time. So I think that if you look at US stocks, US listed stocks are something like 65% of global equity market capitalization. Yes, the S&P gets about 40% of its revenues from overseas, but you can make the argument that maybe there's opportunity for some of that money to go elsewhere. Now, for most of late last year into early this year, there's been a huge amount of money going into emerging markets outside of China. Now, my own humble opinion, China isn't an emerging market, and it hasn't been an emerging market for a long time. But around the time they started building empty cities, and then in some cases knocking them down and rebuilding them again just to pad GDP, started telling me they were running out of ideas. That's not what an emerging economy does. An emerging economy has so many opportunities, they have trouble keeping up with all the things that they can expand to really grow their economy. So, 10 years ago, we saw signs that China was in trouble. But there are a lot of legitimately emerging economies. And I think India has kind of taken the crown from China. But I'm also even interested in places like Indonesia, Malaysia. You have a lot of places that are beneficiaries as China experiences greater woes in their idea of becoming a country where they're making higher quality products, where they're not so much just doing all the manufacturing grunt work, as it were. There's a lot of winners in that space that are the beneficiaries of reshoring, where they're competitively cheaper. And if you look at the cost of Chinese labor over the last 10 years, it's not just a trade war or political issue here. This is a real business issue because Chinese labor is becoming much more expensive for Western companies. So they're shifting over to other countries that can produce those same products at or better quality and at lower costs. And so that's another sort of macro meets momentum catalyst for some of these beneficiaries. And this is where I find there are some of the greatest opportunities that you can see over long stretches of time, where you have the trend agree, but there's also a powerful fact-driven narrative that is providing more interest for institutional allocators, because after all, they're the reason these trends happen, right? It's not you and me trading in our house with our our accounts moving the whole market. It's these really big banks and global operators that are, and sovereign wealth funds that are moving trillions of dollars of capital around. They define these trends, and they do it based on their research, and their research is generally looking for these long-term catalysts, these opportunities that allow them to try to extract alpha. So that's why I always find like the idea is macro meets momentum equals opportunity. Because in a lot of these situations, that's exactly what we're seeing playing out. And the mistake that a lot of macro investors make is getting too tied to their narratives and not letting price action really dictate whether that narrative is valid to the market, which is all that matters. Whether you're going to make money or not, that's all that matters. It doesn't matter if your narrative is right or wrong. So the two have to be married. You have to have the narrative, it has to check out in price, and it has to have staying power. And that's often what ends up being these catalysts for the performance like we've seen in Japan or Mexico, or what we're just starting to see play out in the Philippines, Malaysia, and Indonesia and otherwise.
No, that's perfect. And I kind of wanted to, because I got to get off in a little bit, but I wanted to hop into what we were talking about earlier, which is yields, the Fed, and I just also figured out how to do banners on here. So
awesome.
So the Fed, bonds, and yields. So
yes,
let's hop into that, because I think what we're talking about, it's all tied together, right? Like when we're looking at this stuff, we can't really, like, you and I are macro people. Macro people look at the markets different than other people, where it's like, I could care less, like an individual stock, let's say like Apple. It doesn't mean anything to me on its own. Yes, I can trade it. Yes, I can invest in it. But if the macro matches I'm going to get major outperformance. I think the thing that turned me into a macro trader, which was reminiscence of a stock operator. You have that time, that part in that book where he talks about one thing that's really important, which is when stocks are moving up in a bull market, everything moves up together for the most part. When stocks are moving down, everything moves down for the most part. That's a really important part of trading. So people like us with the macro, I think that's where we start. So the Fed, what are you thinking about PCE this week?
So we're getting expectations in from a number of different economic analysts, as well as the Cleveland Fed, that suggests that we're going to see some reacceleration month over month at core. And you see other things that have fed into this, right? So it's not a total surprise. You've got PPI on the rise, you've got CPI on the rise, you've got services and manufacturing prices. They are diffusion indexes, but more respondents are saying, yes, prices are rising. That's the first time in the manufacturing survey we've seen that response, I think, in over a year. And in the services PMI, it was the highest level of prices are increasing responses that we've seen in months, if not, almost a year. So there's a lot of kind of acceleration underneath the surface. We also look at surveys from NFIB, which are surveying small businesses about how many plan to raise prices over the next 6 months. And there's the most that we've seen really since 2022 there. And this tracks pretty well with CPI, right? So we have a number of different factors that kind of lead us to think, okay, while PCE is a little bit differently weighted than CPI, it's obviously a different way of aggregating data. It's based on consumption rather than just price. But at the same time, there are expectations here that PCE2 is likely to rise. So I think tomorrow's data, particularly on core, is going to come higher month over month. There's a number of factors that feed into that. Transportation costs continue to rise, really one of the fastest rising areas of inflation. And so do shelter costs. And I'm going to bring up shelter costs. I know it's unpopular to talk about shelter costs because, now we're at this point of the cycle where everyone's just sort of content to discount it as being lagged and therefore irrelevant. The reality is that even though owner's equivalent rent and other calculations of shelter tend to have a lag, home prices are continuing to move up in aggregate. So if you look at aggregate measures of home prices, they're at or near all-time highs, even though home sales are slumping to levels we haven't seen since around 1995. Now, that matters because there is more inflation in the pipeline, no matter where we look, whether it's PPI with a 1 or 2 month lag, services PMI with a 5 or 6 month lag, similar with home prices. There's still a number of reasons to be concerned that we may have kind of reached a level that's a little more sticky. And maybe there is even some potential for reacceleration. Now, some folks have comported, inflation with just the commodities index, just looking at a broad basket of commodities, seeing it back to 2021 levels and saying, well, this tells us inflation doesn't matter because this is declining. That omits the biggest cost in American lives, which are not commodities. They're what? Services, right? We don't pay as much for our food and our fuel that we do for our home or our utilities or our insurance or all these other areas. And why does that matter? And not to mention healthcare and health insurance and educational costs, all that rise at multiples the rate of inflation. That matters because there's still room for stickiness. We also have labor costs coming in last time at 0.6%, wages rising month over month. You annualize that, that's 7.2% wage increases over the course of a year. That's also way too high, and it also further suggests there could be some inflation in the pipeline. So why do I keep saying inflation in the pipeline? Because I think this is what the rates market is now looking out to. Recall, we started this year pricing in 6+ Fed cuts. 150 bips or so, give or take 10 bips. What's 10 bips between friends anyway? You go into the year with that kind of exuberance about the dovishness of the Fed, and it was irrational. It made no sense. It wasn't, look, you got the stock market at or near all-time highs. You got housing prices at or near all-time highs. You got crypto picking up. You got speculative fervor, retail participation in the market's really heating up. You've got all these, prices in the pipeline starting to show signs of increases. What was the reason for the Fed to cut in March? There was none. So that's been taken off the table. Then we continued to get data that suggested the economy is stronger than expected, that certain swaths, not all, but really the top quartile of consumers are stronger than expected. That continued to push out Fed rate hikes from May to June to now July being the most likely month where they start. And also, we're now at about 3.5 cuts based on Fed swaps this year. They're really looking for 75 bips, maybe 90 bips of cuts. So it's kind of in that 3.5 level. What does that tell us? It tells us the market is continuing to reprice the resolve of this Fed. A, maybe taking Powell and the speakers a little more seriously here, but B, parsing all of this data and not seeing that dramatic economic slowdown and decrease in the rate of inflation that we had heard so much about being inevitable last year as we came into this year, right? Right. And so this set up some interesting opportunities. For one, when you see something like this, it means, for me, I want to look for an opportunity to fade 2-year note futures, because that's one of the easiest proxies to see where the market is pricing in the Fed and what level of easing is happening. But as we talked about earlier, macro and momentum. I can't just look at it and say, I don't like it, I'm going to short it. I have to see price break its uptrend. And that's when I started to pile into that short. And because it's not a particularly volatile trading vehicle, I did so with some leverage. I've been starting to close that short out, taking off the core, just leaving on 1/3 of the position in runners. But that's an example of seeing how that narrative can meet the momentum, and then you can have a trade opportunity. Now, zooming back out to the main question, interest rate outlook this year, I think on the across the yield curve, rates can move higher from here. I think tomorrow's PCE could be a catalyst for pushing that move further. And it's important because this is the Fed's favorite flavor of inflation, and it's the last reading of PCE we're going to get until their March meeting, where they release their survey of economic projections, which talks about their expectations for inflation, the economy, and the Fed's rates for the rest of the year.
No, that's perfect. I think that's generally the thing that I've paid so much attention to this year that's been absolutely insane, which is, hey, inflation's dead, and it's going to continue to be dead, and it's never coming back. And it's like, wait a minute, everything is sitting at perfect levels for the most part. Not perfect levels as in I'm just looking at TA. Perfect levels as in, when would commercials start buying? When would governments start buying? Things like oil, things like other commodity-based products. They're all sitting at these levels, and people are all getting interested. So once again, this is when bottoms are put in place. We're also seeing manufacturing start to see an uptick. So possibly coming out of this manufacturing or recession environment that everybody's talking about. Now, once again, it could be short-lived, because if they start to cut rates here, sure, everything would move up heavily and inflation would be out of control. But I think the thing you and I have talked about so much over the years, which is inflation has sat under the surface this whole time. Yes. So if it's sitting under the surface this whole time, it could explode at any moment. And the only thing they really need is a catalyst. And the Fed cutting is a catalyst. Heck, right now the Fed is just flat in the market. Everything's moving up. And so many people think of inflation the wrong way. Not saying inflation, like if you look at inflation as one simple thing, prices moving up. That doesn't have to mean commodity prices moving up. That doesn't have to mean what you think it needs to mean, or what an economist tells you it needs to mean. It can also mean that the market is moving up heavily in insane ways. Like some of the moves we're seeing in earnings are absolutely insane, up and down. Like they're insane. This is completely abnormal. Cocoa, that's abnormal. That makes no sense. Once again, Bitcoin, another one. It's just moving like crazy. It's up a bunch more today, across 60,000. This is when liquidity is loose. This is a market that has liquidity. The drivers of the market are pushing everything to the upside. And we could absolutely see like this keep going to the point where the Fed has to go, okay, well, we can't do anything this year.
We might even have to hike.
Yes. They might even have to hike. Like, could you imagine that being the outcome of this year? The Fed hiking rates, they're already so high, but they hike rates. I wouldn't doubt they hike rates. I don't think that, like what you just said, isn't as crazy as people might think that is. Like,
and it's interesting because that was one of our macro advisor contrarian calls for this year, that the Fed actually has to hike before they can loosen, because we see this reacceleration of inflation. It's still early yet. to make that call with any degree of conviction, which is why it was a contrarian call, right? Those are our outlier calls. But we're seeing things take shape, like you say, that make that a little more likely. Now, here's an interesting statistic. Financial conditions right now are looser than when they were before the Fed started their hiking.
I saw
So
that.
it's almost as if nothing has happened.
Yes.
And it's interesting because we have to contextualize it. I know a lot of people are saying, "Oh, well, don't worry about fighting the Fed anymore. They're irrelevant." I would take that the other way. And I would say that you got to look at where the fight against the Fed has been happening and why it succeeded. Well, one of the biggest fights against the Fed happened from our own government. And that was the first half of last year. There wasn't any issuance of debt because of the ceiling, right? And that is net liquidity positive. You don't have that debt absorbing liquidity from bank reserves and from reverse repo markets. Then the back half of the year, you had this enormous amount of government stimulus coming in. You saw large amounts of non-residential construction, lots of investment with building new plants, manufacturing for semis, for the Inflation Reduction Act's capacity and energy and otherwise. And that stimulated the economy, and that added liquidity to bank reserves because the government's spending. They got to pay the bills go to banks. That adds into their reserves. That also fought QT. Right. And then as that's all happening, you've got China adding liquidity into the markets. You've got the Bank of Japan adding liquidity into the markets, sort of all of this more than offsetting rate hikes and quantitative tightening and it sort of impacts that we would have experienced otherwise in the economy and financial markets. So it's not so much that fighting the Fed doesn't matter anymore or that you can do it willy nilly. It's that there's more to the global economy and the markets than just the Fed in terms of purveyors of liquidity. And if those purveyors are more than offsetting the tightening of the Fed, which we can see in financial conditions, then it's as if the Fed did nothing. But it's not in reality that the Fed did nothing. They did a lot. In fact, it was one of the most aggressive hiking cycles we've seen since the late 80s. And if you add QT into it, maybe it's in its own class. But if everyone else is sort of fighting what the Fed's doing and winning, then that feeds into this narrative of, oh, they're irrelevant. They don't matter. The reality, what we learned, is that fiscal, when fiscal is very motivated, can be more impactful than monetary.
Yes, and that's also another point is people read too much into like, hey, this is impossible if the Fed is doing blank. Like it's like, people rates are going up. We can't buy the market. We can't possibly be long the market because rates are going up. Rates are going down. The market can't crash. Rates are coming down. Like all of that is completely ridiculous. Like the market has gone up tons of times as rates are going up, hence rates going up. That makes sense because the economy is doing well. They can start to hike rates and they're doing so. And so the market's still going up. And then the other way around, why would they cut rates? So our big call, and my main thought on this is that they can't really just come in and start cutting. Like they can't just come in and start cutting tomorrow or next month or have an emergency cut or at the next meeting without some form of a crisis. There is no reason for them to cut at this moment. It would make zero sense. I would be incredibly surprised. But there's just like, you have Bitcoin going crazy. The commodities have bottomed and they're starting to move up. Whatever anybody else wants to think or talk about, that's really happening. So you have all of these things here. The market is insane. Semiconductors, Nvidia, whatever Nancy Pelosi's bought in the last 6 months. Like all of these things people are just pumping money into over and over again. There's a lot of money in the money markets. Like it's literally set up to go a lot higher whether they cut rates or not. So if they do cut rates, it's literally giving inflation the match that none of us really want in the world. And if they don't cut rates, people are going to, at some point, get confused because they think it's coming. And then also, if there is a crisis of some sort, that is the only way I could see them really cutting heavily. Like there was, 9 rate cuts at the beginning of this year they were talking about? And then there's
6 or 7.
Like 6 or 7. And then we have like a few still, and it's all crazy. But the only way we get that many rate cuts is through a crisis, and that crisis isn't going to make your portfolio go up. So as people are kind of hoping for and excited for it, I'm not sure if that's really the thing people want to see.
Yeah, be careful what you wish for. If you see that kind of, easing, it's likely not to be for good reasons. And I think any kind of cut in the environment we're in now would end up being a policy mistake. And I think it would be kind of rehashing some of the mistakes of Arthur Burns and being too sensitive to certain areas and not really looking at the bigger picture, which is structural inflation and how that has become more embedded in parts of our economy. So this has been a really awesome discussion, Jason. I've got to cap it here, but
Yep,
let's do
same.
this again soon. And for folks that tuned in, check out our work. Follow us on Twitter, follow us on YouTube, check out what we're doing with our research. There's a lot to dive into. Both Jason and I have been trading markets for decades here. We really love talking about stocks, talking about what's going on in the broader world. And we try to keep it real. We try to keep it objective. There's no unrealistic goals. There's no lottos and Lambos. It's all about, veterans of trading who have been doing this long enough that we know, trading is real work. It's like running a real business. It does involve a lot of, research. It does involve a lot of iterative improvement of what you're doing. You can't just go in and fly by the seat of your pants. But once you start to build a system and you follow your system and you become more disciplined, trading becomes more of a routine. And, you don't find yourself getting as emotional about it. You find yourself just kind of looking at it as, hey, I'm moving inventory. I'm buying inventory cheap. I'm selling it expensive. I'm selling expensive inventory. I'm buying it back cheap. That should be the essence of how we look at trading without any real color of fear or greed. So, Jason, let's do this again soon, my friend. It's been a lot of fun.
All right, man. Sounds good. We'll talk.
Thanks, everyone, for tuning in. We'll catch you soon.